Hello, everyone. Thank you very much for joining this afternoon, for taking time out. My name is Nicole Kozłowski. I'm the Group Head of Engagement here at Carbon Tracker, which is part of the Tracker Group. Today, we will speak about how aligned or misaligned the oil and gas sector is with the Paris Agreement goals. In this webinar, my colleagues will be exploring the oil and gas sector's climate alignment and transition risks through two newly published reports. The first report we will explore is a report called Paris Maligned 3, and it provides a bird's eye view of companies' performance against the various metrics that we have developed, while the second report, Crude Intentions 3, looks in detail at one of these metrics, and that is executive remuneration. These reports are available to you, and you can download both following the QR code that we saw previously on screen. So if you could just go back one slide, you'll also be able to access the supporting slides. We'll make sure to share these QR codes with you as well. And before we dive into the topic, just a very few housekeeping points. The intended runtime is 40 to 45 minutes, depending on the number of questions asked, with a 60-minute hard stop. There will be a short presentation of the key points by my colleagues before we then move to answering your questions. If you would like to ask questions, please do so via the Q&A function. The only thing that I would ask you to do is to please not send them anonymously, because this stops the team getting in touch with you afterwards in case they're unable to answer anything live. And lastly, a replay will be sent in the days after the webinar. So with that being said, a few words on Carbon Tracker in case you don't know us. Carbon Tracker is a not-for-profit financial think tank. Our vision is a fully decarbonized global economy well before 2050. And all our research converts climate science into financial risk and reward, with the aim to accelerate the energy transition by mobilizing the financial markets. And all our work is for the common good. You can find both reports free to download and access from our website. You've just seen the QR codes, but you can find more of our research on carbontracker.org, as well as the usual third-party investor platforms, which you can see on the screen here. And with that being said, let's start our session. Joining us today is Rich Collett-White, who is an analyst on the oil, gas, and mining team. Rich is the lead author of Paris Maligned 3, and his previous work includes Stranded Exports, Absolute Impact 2024, and Petrostates of Decline. And joining Rich is my colleague Said Rasul Ashkhanov. He's an associate analyst, also on the oil, gas, and mining team. And Said is the lead author of Crude Intentions 3, and his previous work includes Crude Intentions 2. You see, we like series here at Carbon Tracker, Absolute Impact 2023, Midstream Running Dry, and Petrochemical Imbalance. And with that being said, Rich, I'll invite you to join us, and we'll hand over to you. Thank you.
Great, thanks, Nicole, and thanks everyone for joining. So before delving into the report findings, I'm just going to give a brief overview of some of the work that we do on oil and gas here at Carbon Tracker. So our research can really broadly falls into three key themes. Firstly, the financial and strategic implications of the energy transition. Secondly, assessing corporate climate alignment. And thirdly, unpacking these considerations for financial regulators and policymakers. And those first two bullet points, we kind of see those as quite distinct lenses through which to assess companies' transition plans, and the findings from Paris Maligned 3 can be considered from both those angles. And we explore these themes through a range of products. So reports, notes, and blogs, two of which we're going to look at today, and then analytics and data. You can find those in our reports, but they also feed into frameworks such as the Climate Action 100+ initiative. And then lastly, company profiles, and we're currently updating those as the AGM season gets going. So please do look out for those. Next slide, please. So moving on to Paris Maligned 3, our work in this area has evolved over the years as we've built more components into our analysis, and you can see a few kind of iterations at the top there. This year's report brings two main new elements in. Firstly, we incorporate a methane metric, which consists of looking at companies' methane-specific targets, but also their progress in accurately measuring all of their methane emissions. And secondly, we have expanded the company universe and added particularly national oil companies to the universe, wholly state-owned national oil companies, some of which are listed there. Next slide, please. So to give a summary of our research approach here, we've developed 6 metrics to analyze oil and gas companies, and these are largely forward-looking, as we believe that's kind of the most relevant and decision useful for investors and other stakeholders. And as you can see there, the first 3 are focused explicitly on oil and gas production, and then the following 3 are linked. And we assign scores to companies for each of these 6 metrics. And then we bring those together in a kind of weighted average score, which I'll explain later. And I'm now going to go through each metric in turn with some top line findings, but leaving executive remuneration for Saeed to go into in more detail later in the webinar. Next slide, please. So starting with those first 2 metrics on investment options and recent project sanctions, these really involve quantifying to what extent companies' upcoming and recently approved projects are climate aligned or exposed to transition risk. And we do that by bringing data from the IEA's demand scenarios together with global oil and gas supply data from Rystad Energy. And that enables us to determine the compatibility of different assets with different transition scenarios on a least cost basis. Next slide, please. And so these are the results of our modeling on investment options. And as you can see, there's a kind of quite wide spectrum of how companies perform on this metric. And just to explain that chart, so the orange represents the proportion of CapEx that companies would be expected to improve under a business as usual scenario that would likely be compatible with a 1.7 degree scenario, and the red is that which would be kind of likely incompatible with that scenario. The grey represents CapEx that would exceed the 2.4 degree business as usual scenario, and that's from the IEA's STEPS scenario. And as you can see, that companies on the left, they have the most competitive project options, and those on the right have the least. And you can see on the left, we've got Gulf national oil companies, which fare best with the kind of least costly production. And on the right, you have oil sands producers and Ovintiv, which is a US shale producer. So there's quite a wide spectrum there. And moving on to the next slide. So we'll turn now to the recent project approvals. And here we see that scores have really fallen across the board. And that's a result really of a higher number of approved projects in recent years, and a kind of shrinking space in the carbon budget for additional projects. And you can see on the right, there's a table listing the largest projects that would likely fall outside a 1.7 and 2.4 degree scenario. And that's dominated really by LNG projects. And these are particularly misaligned because of the LNG oversupply that's forecast by the IEA. And investing further in LNG carries significant risks as a result. And that's something that we explore in a number of recent reports from our team, including turning tides and stranded exports. Next slide, please. So moving on to companies' stated oil and gas production guidance, we summarize that in a table on the right. And the key findings are really that there has been backsliding from European listed companies. So Shell, BP, Equinor, and Total. And Repsol and Harbour, by contrast, they score highest as a result of having plans to decline modestly oil and gas production in the coming years. And there have been some US companies which have slowed their rate of increase, and that's partly because of kind of US economic headwinds currently, and potentially the impact of tariffs, although it's important to bear in mind that lots of these targets were brought in prior to tariffs, so we'll kind of have to see what impact that has on production guidance in the coming weeks and months. Next slide, please. Next, we look at our metric on greenhouse gas emission targets, and this is drawn from our absolute impact series, and these remain largely unchanged since last year, with most companies not setting Scope 3 emission targets, so those don't link through to the finite carbon budget, and that's the case for all of the newly assessed NOCs that we added to our company universe this year. Next slide, please. And this slide looks at our new metric this year on methane, and that's drawn from both absolute impact, but also assessments that are made by the UN Oil and Gas Methane Partnership 2.0, and they look at the progress that companies are making on directly measuring methane emissions. And overall, companies are scoring better on methane than overall greenhouse gas emissions, but they're still quite a considerable way from Paris alignment, and that's particularly due to the exclusion of non-operated assets from their targets and also midstream gas assets. Next slide, please. So here we bring all of this together, essentially looking at all of those six metrics and weighting them according to what we view as the most and least meaningful for climate alignment and transition risk. But we've also made this table interactive this year with the help of colleagues in Tracker Group's data and modeling team. So that's going to be available on the landing page for Paris Maligned 3, where you can kind of adjust those weightings and see how companies fare. But overall, the findings are really that no major producer has really come close to Paris alignment yet. Repsol does best with a D, and generally companies are only performing well on one metric, if any. So, for example, with Repsol, does reasonably well across most metrics, but falls down on executive remuneration. Contrasting with, say, Occidental, which does well on executive remuneration, but falls down on all the others. But you can see there's kind of significant variation across our company universe, and also that the newly assessed NOCs all score particularly poorly. And this is particularly looking at it through the lens of Paris alignment, but you can also view these metrics as proxies for transition risk exposure too. So I'd really recommend looking in more detail at the reports on how each company fares. Next slide, please. So it's also important to acknowledge that these aren't the only relevant factors when considering these issues. There's also companies' exploration plans, what the breakdown of their capex is between new and existing projects, what their lobbying activities are, what the lifetime of their assets, whether they're more short cycle or long cycle, and also what their kind of divestment plans are for assets. And we explore those in more detail in the company profiles that I mentioned. So if you're interested in a particular company, would really encourage you to look at our specific company profile. Next slide, please. So concluding, we really see the following use cases as the key ones for our analysis. So for responsible investment and stewardship teams, they can use this analysis to inform asset allocation decisions, particularly within sustainable or so-called sustainable financial products, and to inform proxy voting. They can use our scoring methodologies to identify what best practice looks like, and then looking at our analysis to highlight, for instance, where the reputational risk might be highest. For banks and insurers with net zero commitments, they can assess client Paris alignment and in the screening process and also when developing lending policies. And finally, for mainstream investors with no climate mandate, they can really, as mentioned, view these as proxies for transition risk exposure. And with that, I'm going to hand over to Said to take us through his Crude Intentions 3 report. Thank you.
Thank you very much, Rich. They can all hear me and see me. So yeah, Crude Intentions 3 is one of the reports that informed the overall assessment in Paris Line 3. And as has already been mentioned, the focus of this report is executive remuneration. So without further ado, let us start. The thesis of our research into executive remuneration is quite simple. We're trying to assess how exactly chief executives at companies are incentivized to act. And the logic is simple. First of all, the strategy is set by the board of directors, but the actual people who implement the strategy are chief executives. Now, chief executives are obviously influenced by their bonuses, by their pay. And the size of the bonuses, the size of the payout depends on the key performance indicators that go into those reports, into those payouts. Now, our job is to quantify the influence of these specific incentives. And the way we do it is also simple. First of all, we isolate the variable pay that is linked to specific key performance indicators. This means removing things like restricted stock units or restricted options and removing the fixed component, which is the cash salary. Then in these, we tabulate all metrics that we can find, and then we categorize them into one of four different categories. The first one being direct growth incentives, which, as the name suggests, incentivizes growing oil and gas production. The second one is indirect growth incentives, which include metrics that are likely to incentivize growing oil and gas production, things like free cash flow metrics and EBITDA. Next up, we have growth neutral metrics, which can be achieved regardless of the strategy chosen, whether it's to grow oil and gas or respond to the energy transition. And finally, now that we have mentioned it, is the transition response metrics themselves, which are a collection of measures that can incentivize a sort of a proactive approach to tackling the energy transition. This may be diversification, this may be distribution of cash to shareholders, but it can also be a reduction in oil and gas production. And moving next are the results of our analysis. We analyzed all 30 companies in our core company universe. And I want to start with NOCs. This is one of the highlights, but not the highlight of our report, is the lack of transparency at national oil companies. And this is something that we did anticipate. This is something that we have seen previously. What you see here is 7 companies that have failed to fully disclose their remuneration plans. You have Petronas with just 90%, with 90% undisclosed, PetroChina with 70% undisclosed, and Petrobras with only half of that undisclosed. Given this lack of disclosure there, and we mentioned them later in this presentation, we decided to exclude that in our following analysis of of specific metrics. Starting with the first category, we found that 3/4 of oil and gas companies in our core company universe continue to incentivize direct growth. This is largely the same lineup that we had last year, but one notable change is Shell, which removed them in 2023. Overall, looking at the entire universe, we saw on average a decrease in the relative influence of direct growth metrics, which may be slightly good news, but highlighting like good examples of CNRL, which decreased its share significantly from 1/3 to around 5%. Moving on, we have indirect growth metrics. These metrics were found in a larger number of companies. They exert a much stronger influence. And overall, year on year, we saw a growth on average in the relative share of these. So what you see here is a partial offset of the declines that we saw in direct growth metrics. I'd like to highlight one notable example here is Occidental Petroleum. What you see here is the lack of any type of growth metrics, which means Occidental Petroleum is the only company in our company universe that does not incentivize growth among its executives. Now, moving on, I'd like to highlight two examples of metrics that we found to be unclear. The first one is at Synovus. You see a large slice here. That will be metrics like strategic initiatives, which we couldn't quite pin down. And the second one is expand energy, a very tiny sliver over there, and that things like leverage partnership, which again, we were not able to categorize into any one of four categories. Moving on, dominating executive pay is growth neutral incentives. So these are financial ratios, these are safety events, operational emissions reductions, anything that, again, it does not directly incentivize changing the overall strategic course of the company. And finally, on the right-hand side, you see transition response metrics. Only a half of investor-owned companies incorporated these, and these are only diversification. So metrics like distribution, an increase in the distribution of cash or emissions reductions is not currently on the radar. And while for some companies like Eni, ExxonMobil, BP, and to a lesser extent, Shell, this may be, the Shell, they may be a priority for other companies. They may be more of a side quest. Now, so much for 2023. Let's talk about prospective disclosures. And I might note that this data is for 2023, which at the time of reporting was the latest, fullest data set that we could build. So here I would like to draw your attention not to something that changed, but to something that didn't. The other 14 companies, investor-owned companies in our company universe, continued to disclose their remuneration policies retrospectively. So all the proxy statements that have just come out will have all the remuneration policies listed for 2024, not 2025. So the obvious question to those companies will be, if these 6 companies have disclosed their remuneration policies prospectively, what's stopping them from doing the same? Now, if we want to summarize everything that we've just went about, the first one would be a decrease in the influencer's direct growth metrics. So regardless of what angle you're looking at, whether it's risk or climate alignment, this reduces the exposure to these incentives and reduces the probability that the companies will, that the CEOs will be incentivized to grow production. However, we see a growth in the share of indirect growth metrics. So overall, in totality, we see that growth metrics of both types continue to incentivize nearly all CEOs in our company universe. The third finding of our report is, again, transition response metrics, which incentivize exclusively diversification and not any of the other types of transition response measures. And finally, we saw that NOCs have largely failed to disclose their remuneration policies, not just prospectively, but also retrospectively. That concludes our whistle-stop tour of Good Intentions 3, but you can read our report for more detail on things like the metric breakdown at each company over 21-22, over the years of 21-23, then the vesting periods of long-term plans, an analysis of emission reduction metrics and a comparison of the best emission reduction metric in a compensation plan and the most ambitious corporate target. And finally, we provide key engagement questions for investors. You can find our report here or follow the link below. Moving on to the upcoming work from the oil, gas, and mining stream specifically, we have 3 things coming up. Obviously, Rich has just mentioned is the update to our company profiles. So you will be able to find them here as they are published. Then we are looking into aviation, specifically into aviation decarbonization pathways and how that's going. And finally, we are planning research into Canadian petroprovinces later in the year. That concludes my part. Nicole, over to you.
Great. Thank you both. Some very interesting insights into the wider issues, and then also a deeper dive into the links to executive remuneration. We're going to have a brief Q&A session. So just to highlight, if you do have any questions, please put them in the chat function. We received quite a few already. And let me maybe start with one that is quite topical, Rich, and that one is for you, because you spoke about the rollbacks in the oil and gas sector. To what extent have these rollbacks been sparked by the new US administration?
Thanks. Yeah, I mean, it's a very, very timely question. I think they've definitely been a factor, but it's also important to acknowledge that many of these rollbacks predate the US election, and it's also partly about kind of global macroeconomic factors, the inflationary environment, and the kind of high interest rates that we've been experiencing in the aftermath of both COVID and Russia's invasion of Ukraine, and the impacts that's had on clean energy. And there's always a kind of a bit of a lag time, so I think we'll see more of the effects in the coming weeks and months from US policies. But yeah, it's definitely part of the overall picture.
Thanks, Rich. And maybe sticking with regulation, one of the questions we've also received was whether you've seen an impact by the EU methane regulation already. Do companies already react to that on a global level?
Yeah, so I mean, companies are mentioning it in corporate disclosures among their kind of the regulatory environment that's sort of coming down the track. And I think it is likely that companies are making plans based around this, particularly given that it will impact oil and gas imports and oil and gas imports associated with high methane emissions, such as LNG from the US. Those are going to be particularly at risk. So that's going to be feeding through to company strategies on that. There is a bit of a question mark on the EU methane regulation in amongst the kind of the tariff and trade wars that are going on at the moment. So we'll have to kind of see exactly how that sort of shakes out. But it's definitely a consideration for companies at the moment.
Great. And then maybe lastly, maybe a bit of a broader question to you, Rich. Looking at these findings, do they indicate that the energy transition is faltering?
Yeah, it's a fair question. I mean, there definitely have been headwinds, but I think it's important not to exaggerate that. Clean energy investment is still increasing year on year. Costs are still falling in most cases for clean energy technologies. And yeah, but when you're kind of looking at the oil and gas sector's contribution, I think it's important to keep in mind that quite a small proportion of clean energy investment came from the oil and gas sector before this rollback. According to the IEA, it was around 1%. So I think shouldn't kind of overstate that too much. And equally, oil and gas companies, I think, should be cautious about overreacting or kind of overcorrecting on this, particularly in the case of long cycle projects, which would face those kind of longer term transition risks. Oil and gas demand is still expected to peak relatively soon. So yeah, I think that's shouldn't kind of overreact too much.
Great. Thank you, Rich. And Saeed, we've had a few questions for you as well. Maybe starting with a broader one. We've seen some of the data on remuneration. What does a good compensation package look like?
Can you repeat the question, please?
Yeah, sorry. So the question is, what does a good compensation package look like? We've seen some of the data on remuneration, but if you had to summarize it, what would that be?
One that excludes direct growth and indirect growth incentives, most probably. The reason being is that replacing these with metrics that are growth neutral, things like financial ratios, these can be achieved regardless of the strategy chosen, and these could allow the CEOs, the chief executives, to pursue a vision of transition that does not impact their payout, so it sort of unshackles them. We are not commenting on whether that should include transition response metrics, because for each company, the path chosen is up to them. So we're strategy agnostic, but yeah, direct growth and indirect growth incentives are incredibly risky if the energy transition unfolds at a faster pace than expected.
Thanks, Saeed. And a question that just came in, and I guess is very much linked to that, is would it be possible to derive a relationship between growth incentives and less charismatic, more analytical, less transition competent CEO, and thus persistent absence of transition?
I don't think I quite understood the question.
Let's maybe take that one offline, and we'll answer that in person. But another thing that we've we'll answer it via email. Another thing that has been asked was on carbon credits and whether our team qualifies carbon credits or CCS as a mitigative action. Maybe either of you wants to take that one.
I think that's a question on remuneration, and we don't assess like mitigative action itself. What we do assess in transition response is whether the metric falls into one of three categories, which is diversification, cash distribution, or emissions reduction. On cash distribution, definitely does not apply. On emissions reduction, no, because as we set out in Absolute Impact 2024 and in our series of Absolute Impact, for an emissions reductions target to be considered credible, it must result in a natural depletion. It should not be based on technologies that have not yet been proven at scale, and CCS has yet to prove itself at scale. And finally, does it fall into diversification? It depends. If CCS or carbon credits are offered as a sort of a service, reduction as a service, then yes, it's a diversification strategy. If these are used to mitigate own emissions, at best, we can classify these as a reduction of operational emissions, which is Scope 1 and Scope 2, in which case we put them into growth neutral.
Great, thanks, Saeed. And another question on that is increase in share price considered a growth metric in this analysis?
Come again? Is increased share price considered a growth metric?
In this analysis, yeah. How do we classify that?
I wouldn't say so, because if you look at it, share price can be influenced by many factors, and this does not necessarily focus entirely on oil and gas production, on an increase in production. It can be market sentiment. It can be things like a healthy balance sheet. So it would be unfair to pin the share price entirely on growth. So we would put them into growth neutral. And one example of those metrics is TCR, total shareholder return, whether absolute or relative. We would always classify them as growth neutral.
Great. And maybe the last question before we move on, Saeed, that one's for you as well. The question from Laura is, why are NOCs evaluated at the same level as private companies? Is it the same as private companies growing the same as NOCs are growing? Should there be a distinction between the two?
Well, the distinction, I think, is up to our target audiences, up to the financial actors to make themselves. We just provide analysis. Considering that a lot of these companies are active in the bond markets, considering that these companies do tap into private markets as well, I don't think why we should exclude them from our analysis and from the wider analysis under, say, Paris-aligned. Rich, what do you think?
Yeah, I mean, I think the key difference is obviously the kind of lack of transparency that you often get from NOCs, and so that makes it very difficult to conduct some of this analysis. But you know, we do what we can with the publicly available information, and I think you have to use consistent metrics across the board, regardless of the company type. You know, it doesn't matter what the sort of company structure is when we're talking about oil and gas production and overall volumes and therefore overall emissions and kind of contribution to climate change. Yeah.
Great, thank you both. I think we've answered most of the questions. So a few more in the chat that we'll reply to via email. Thanks, Rich and Saeed. And before we wrap up the webinar, we just wanted to look forward. We've heard of a few reports that are coming out from the oil and gas team, but there's a few other things that we wanted to highlight. So if we can just get the slides back up for a moment. You might have seen our latest report that has come out from the Accounting, Audit and Disclosure team. The newest installment in our Flying Blind series is now available on our website, and you can also use the QR code here to download it. And I also just wanted to highlight that we're hosting another webinar next Tuesday on heavy-duty vehicles and electrification, which you can register for using the QR code shown on the screen, and we hope to see many of you there. And that brings us to the end of our session today. A very warm thank you to both Rich and to Saeed and to the wider Carbon Tracker team and putting this together, and especially to all of you joining us this afternoon, taking out the time to engaging with this content. We hope that you find it useful and helpful. If there are any further questions that you might have, please get in touch with us. We'd be happy to answer them, and otherwise wish you a very good afternoon and a good rest of the week. Thank you and goodbye.